Hey everybody, and welcome to Stock Abilities. I'm going to be covering triple witching dates, expirations, and hours explained in 2020. So make sure to subscribe to that channel if you want content just like this and follow along. I'll be covering just all those different aspects of triple witching and what that means for you coming into the September month here, and for previous months and future months, and why it's such a big deal and why it's volatile and all these kind of things. So make sure to listen to the end of the video for something really exciting. But essentially, to summarize that, as Investopedia would summarize, is triple witching is the quarterly expiration of stock options, stock index, futures, stock index, option contracts all occurring on the same day. Why this is significant is that's a lot of volatility coming into basically a whole week span. So you're having around the entire world here all of these contracts expiring all at the same time. So it's going to create a lot of volatility, a lot of exercising. If you guys are not familiar, if you're sort of new to trading, that means they're exercising contracts to turn into shares. That can create a lot of upside volatility. Sometimes it's bearish, sometimes it's bullish. It's more on the skew of a bullish trend than it is a bearish, historically, being that witching has always kind of been on an uptrend overall. You got basically, according to Tasty Trade here, Tasty Works Associated people, TD Ameritrade Associated, they used to be from TD Ameritrade, went to Tasty Works, made Tasty Trade. They gathered data over the last 10 years, and they concluded that triple witching expiration week was very bullish, and that the week after expiration was very bearish. uh, in my opinion, at least in regards to why that is that you have all of these people basically mass expert exercising their contracts for that week. So they're trying to pump the premiums as much as possible to get the maximized profits for that quarter. And then there's also closeouts, and then they're shuffling monies. You had a recent rotational here in the markets. This always seems to happen around those triple witching dates, likely to mass pump those premiums right before they expire so that they can get the most profit out of their positions. And then, of course, the following week, you have often a mass decline. My theory on that is that they're basically dumping the premiums as low as possible to get in as cheap as possible, because they're basically buying fresh contracts for the weeks, months to come. So they want to get their best possible price if they're going to be holding for those weeks and months, maybe even years, depending on the contract in particular. Uh, According to Season X here, a particularly steep increase in prices tended to occur between the third day and the day immediately preceding triple witching expiration days. The average gains in these 2 days was 0.47%, which is equivalent to a very large annualized gain of 134.59%. They say this is more than 25 times the average annualized gain of the S&P 500 index recorded over the entire 15-year period under review. Investors can take advantage of the strong uptrend in the days before witching dates, increasing their exposure to equities. By contrast, the expiration date itself, which many investors are focused on, was typically characterized by a remarkable lack of volatility. Then, just going into more of the data side of things, because this website says this website says that. You ultimately want to go for the data here, and essentially, as you can see here, the primary short-term pattern that they found here through this source here is a weak weak pattern during this period. Both the Monday of triple witching week and the Monday following triple witching week were significantly negative, since the Friday prior to and after triple witching was positive. I in this regard, in this week recently, it was more of like a sideways. It wasn't really overly bearish, at least for the markets themselves, more so on the tech side of things. And then you had the Friday preceding period and found it was also positive. The triple witching Friday was neutral on average. The percentages in the table below are the cumulative gains losses for each day over the past 27 years observed. You got upsides, you got downsides, but As you can see here, historically it tends to be bullish more than bearish. You can interpret that data however you want. You might say, well, since the market's generally on an uptrend, this data might technically be meaningless, because you might be saying to yourself, well, if they're generally on an uptrend, you know, on the markets, is this data really all that accurate and relevant to triple witching? In my opinion, yes. Some people might interpret it a different way, but historically, you generally see a stronger performance on the week of, and then a weaker performance on the week after. Uh, as you can see here, and they have some more data here if you guys are interested. You divide all these totals by 27 for the months column, or by 104 for the 4 months column. You will find that they are worth trading with an index fund. They do illustrate a seasonal pattern. It's possible that a broader day of week pattern exists, and they're seeing a slice of that. Then they go on in more details here, that where during bull markets, Friday's relative performance is stronger, and during bear markets, Fridays are weaker, since traders do not want to hold stocks over the weekend. So that could be getting into some other data that's not even necessarily relevant to triple witching, quadruple witching, as they call it in some cases. The 4 month total support the strong weekdays of the week pattern during the time frame. The seasonality of the month matters more. March and December fall into the strong seasonal months of the year, as partially evidenced by their cumulative totals of 31.2% and 87.9% comparative to the 8.6% and 12.3% for June and September, respectively. So this last, witching coming up, you could say that it might be the holidays that are driving the demand over anything else. And whereas the non-holidays, not so much. So, you could factor in seasonality and other things as well, and that could be affecting those percentages. Of course, something recently, not recent, but over the years prior to basically more seamless trading like we have now with free trading and all this stuff, more people are in the markets. There's weekly expirations now, so people can kind of readjust their monies a lot better, whether it's hedge funds, institutions, or just an individual retail investor. And it makes it a lot easier to roll that risk, as opposed to, you're buying a contract 3 months out or something like that. So it would create a lot more extreme volatility. Volatility is getting a little bit more stable now because of that aspect. So essentially, you're going to be saving monies and risk, because you're not going to be taking out these longer expirations. You're not going to be forced to necessarily just buy this longer expiration. You can maybe push your contract a week or two later, instead of 2 months or 3 months later, where the cost is heavier. And then, if it balances out the risk overall more in general, and it's easier to visualize what's going on, as comparative to older days where you didn't have electronics, you didn't have a computer. You basically had to call your broker and say, hey, I want to purchase this, or I want to sell this, due to the volatility that was going on. As they put it, as a retail trader, the fact that it's different now is a much better thing. Kanahan said, electronic trading has evened the playing field, so the retail trader has a fair shot and can manage risk. All orders are now electronic, so it's not just traders in a pit. Markets are more efficient. Swings are less dramatic in the last few minutes of the day. Essentially, individuals have more control over their investment, whereas previously they were heavily restricted, whether through a phone call or email or what have you. On top of that, fees were a lot more significantly larger during those times. Uh, as they say, retail investors still need to be on their toes. I already covered this in other parts of the video here, that there are ups and downsides to the volatility. Volatility is volatility, because the increased volume, the chance of some abnormal price moves. So you might be bullish, but if you're going to have more awful spreads. You're going to have more volatility on the upside than the downside during the day. So if you're a day trader, That could be a good thing. It could be a bad thing. If you're a swing trader, that could be a very bad thing because of that major change in the volatility. You might be ending up getting in a much more awful spread than you realized at the time for the bid and the ask. So then you run the risk that you're actually overpaying for that premium. You're paying much more into the extrinsic value than the intrinsic value, and then you run that risk, especially usually since historically the week after witching is bearish. So you might buy a contract this week through the hype of the triple witching and the rotational monies, and then into the following week that option's going to crush significantly due to the fact that they're rotating into fresher contracts for the following weeks and months. So in the end, it's all up to you whether you want to trade the week, but historically it tends to be very, very volatile. It's not really recommended to consider getting into swings or longs or anything on the week of witching expiration. The week after would generally be the best because they're trying to push the premiums as low as possible to get in at their best possible entry. Sort of like if you're looking at an upgrade or a downgrade, when you see an upgrade on the stock market that's historically kind of bullish temporarily though, but then you think they're upgrading, and then in that scenario they're more likely trimming their position, whereas in a downgrade they're trying to add to their position by pushing people out and taking their position for a longer term aspect view of that concept there. But thanks for listening in. This is a lot of what I wanted to cover in triple witching. The main thing to take out of all of this is that this is increased volatility. If you're new to trading, this is not the best idea to get into trading in this very week. You might have a skewed reality of what the average trading week or month is like. You'd end up probably saying to yourself, well, hey, I did really good now. But then you were getting a lot of that extrinsic pump, that hype pump for the rotational, for the mass exercise of those leftover options and futures contracts and all this kind of stuff coming together that creates an unrealistic average week to week on the stock market. So that is something for you to consider when you are trading. Just remember, uh, ultimately, there's upsides and there's downsides to triple witching, quadruple witching in 2020. So when you are trading, keep that risk in mind when you consider doing this. uh, in most cases, I'd recommend for beginners to avoid trading this week. For those that are a bit more on the intermediate to more advanced level, it's a good thing to trade it, but you got to watch your positions very carefully. You got to watch the spreads that you're entering very carefully. You're going to have a higher implied volatility. You're going to have more upside, downside. And if anything, the best thing you might be able to do during a triple witching week is to simply sell calls and sell puts for the following weeks and months because of that rotational move. And then into the following week, they tend to like to crush a lot of those other option contracts. So you're going to have a big dump right afterwards, which can result in a lot of profits on the selling calls and the selling puts end of thing. So just something to think about, even in the aspect that if they're going to be pushing the market down, even just general shorting would be good the week after. And, general buying of more equities shares the week after as it's dumping, because you're going to get the best possible entries ever, because that's generally when they're entering as well. That's about all I wanted to cover in this video. If you like this video, you want more videos about triple witching or just other terminology, make sure to leave the comments below into that input and let me know what you think about it, how you feel about the volatility, and what you feel the future of the market might be doing. Appreciate you listening in the whole way through. And as I promised, I'll give you the surprise. I'm going to say hello. So, hello. Thanks for listening in. Have a nice day.